Forget everything you thought you knew about dividend ETFs. While most investors flock to SCHD for its reputation as the gold standard of stability and steady payouts, a different ETF has been quietly rewriting the rulebook, crushing returns, minimizing losses in downturns, and proving that dividend-focused funds don't have to be boring. This isn't just another income play. It's an ETF that has consistently outperformed expectations and flipped the script on what dividend investors thought was possible. This fund isn't just keeping up with SCHD, it's threatening to leave it in the dust. And today, I'm going to show you exactly how it works, why it's different, and why so many investors are suddenly paying attention to it. So let's start with the results, because at the end of the day, numbers tell the real story. Since its launch back in 2015, this ETF has been compounding at an average of over 18% annually. For comparison, the S&P 500 has managed closer to 11% over that same time frame. That gap might not sound like much at first glance, but when compounded over 10 years, it's the difference between simply keeping pace with the market and absolutely blowing past it. Fast forward to 2025, and the outperformance becomes crystal clear. Year-to-date returns? Already north of 22%. Over the last 12 months, a staggering 35% gain. Look at its 3-year track record, and you'll see average annual returns just shy of 30%. Stretch it to 5 years, and it's still compounding at more than 21% annually, results that very few funds in the dividend ETF space can even come close to. Now let's put real money into the picture. If you had invested $100,000 into this ETF just 5 years ago, and added $1,000 every single month, you wouldn't just be ahead, you'd be sitting on well over $350,000 today. Stop adding new money and let it sit for another 5 years at that same pace of growth, and you'd be knocking on the door of $1 million. All right, before we continue, if you like this kind of content, hit that like button, share this video, and subscribe. Quick reminder, this video is for educational and informational purposes only. It is not financial advice. Investing in stocks carries risk, so always do your own research before making decisions. So, what is this market-breaking ETF? It's the Invesco S&P 500 Momentum ETF, ticker SPMO. And when they say momentum, they mean it. This ETF doesn't just buy the market. It identifies the 100 strongest stocks inside the S&P 500 based on momentum, rotates into them, and rides the trend. That's why it has been outpacing the S&P 500 year after year, while also holding up better during downturns. So why is SPMO breaking the market in a way that has everyone talking? The answer comes down to one word: momentum. Unlike traditional dividend ETFs like SCHD, which focus on stability and dividend history, SPMO takes a very different approach. It looks at the entire S&P 500 and cherry-picks only the 100 stocks with the highest momentum scores. In plain English, that means it's capturing the stocks that are not only performing strongly today, but are statistically more likely to keep performing tomorrow. Here's how it works. The index behind SPMO measures the price changes of every stock in the S&P 500 over the last 12 months, adjusts those results for volatility, and then ranks them. The 100 names with the highest momentum scores make the cut, and the fund rebalances semi-annually to make sure it's always holding the strongest performers. That's the secret sauce. You're constantly invested in the hottest trends within the S&P 500 without having to pick and choose them yourself. And the results speak for themselves. Over the past 5 years, while the S&P 500 delivered solid returns, SPMO pulled ahead with 130% gains compared to just 84% for the S&P 500. That's not just outperformance, that's market-breaking territory. But here's the kicker. It's not just about the highs, it's also about the lows. In years when the market stumbled, SPMO didn't fall as hard. Take 2018, for example. The S&P 500 dropped about 4.5% that year. SPMO? Down less than 1%. Fast forward to 2022, one of the ugliest years in recent memory. The S&P 500 fell nearly 18%, while SPMO dropped just 10%. That might not sound like much, but avoiding big drawdowns is exactly how long-term wealth compounds. If you lose less in bad years while making more in good years, the math works in your favor, and your portfolio grows exponentially faster. Now let's compare this to the ETFs most dividend investors already know and love. Take SCHD for instance. SCHD is a phenomenal dividend ETF. Low fee, high quality, consistent growth. But SCHD is designed to be slow and steady, not explosive. It focuses on companies with a long track record of raising dividends, like PepsiCo, Coca-Cola, and Texas Instruments. Great companies, no doubt, but they don't offer the same kind of rapid growth or momentum upside. That's where SPMO flips the script. Instead of betting on the same old blue chips, it rotates into whichever companies are leading the market right now, whether that's Nvidia, Meta, Broadcom, Amazon, or Tesla. Speaking of Nvidia, let's talk holdings for a second. As of this year, SPMO's top positions include Nvidia, Meta, Amazon, Broadcom, JP Morgan, Tesla, Walmart, Netflix, Palantir, and Costco. Notice what's missing? Apple and Microsoft barely show up in SPMO's top weightings, even though they dominate traditional ETFs like VUU and QQQ. That's a good thing. It means SPMO gives you exposure outside of the usual mega-cap tech names, and instead captures the new wave of market leaders. And here's another big advantage. SPMO automatically rotates. You don't have to worry about guessing when to sell Tesla and buy Palantir, or when to rotate out of consumer stocks into tech. The ETF does all that heavy lifting for you every 6 months. If the leaders change, SPMO changes with them. That's huge for investors who don't have the time or expertise to actively trade momentum stocks, but still want the benefits of momentum investing. Now let's talk cost. With such an advanced strategy, you might expect a sky-high expense ratio. But SPMO's fee is just 0.13%, lower than QQQ, lower than most growth ETFs, and dirt cheap compared to active funds that claim to offer similar outperformance. For every $10,000 you invest, that's only $13 a year in fees. Practically nothing when you consider the returns it's been delivering. So why is this important for dividend investors specifically? After all, SPMO isn't known for its yield. Its dividend yield is only about 0.5%, far below SCHD's 3.5% or JEPI's 8-10%. But here's the thing. The magic of SPMO isn't the dividend itself, it's the compounding total return. By focusing on momentum, you're not just collecting dividends, you're capturing capital appreciation on some of the market's biggest winners, and doing it in a way that avoids catastrophic drawdowns. For investors building wealth with an eye on early retirement, that's invaluable. Think of it this way. SCHD pays you a nice income stream, but SPMO is the growth engine that accelerates your portfolio's value. Pairing them together could give you the best of both worlds. Consistent cash flow from SCHD and market-beating compounding from SPMO. And the comparisons don't stop there. Look at QQQM, the popular NASDAQ growth ETF. Yes, QQQM has delivered higher peaks in some years, but in downturns, it gets crushed. In 2022, QQQM fell more than 32%, while SPMO limited its losses to about 10%. Now, that combination, higher highs with shallower lows, is what makes SPMO a unicorn. It's giving you growth like QQQ, but with downside risk closer to SCHD. This is why so many investors are calling SPMO the ETF that broke the stock market. It's defying the usual trade-offs between growth and safety, proving that you can have both if you follow the momentum strategy correctly. Now let's imagine where this could go. If the average annual return of 18–20% continues, $10,000 invested today could turn into more than $52,000 in just 10 years without you having to trade in and out of individual stocks. Stretch that to 20 years, and you're looking at over $270,000. That's the power of compounding when you combine momentum with diversification.